Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated. And today's video lesson is going to talk about granting or selling options as well as buying options and when you might want to do that in a situation. But before we get started, let's go ahead and cover the risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results, and you should only use risk capital when investing in markets like futures and options. Okay, well, over the 20 plus years that I've been a commodity trader, I've heard a lot of arguments between option grantors, sellers, option writers, premium collectors, whatever you want to call it. The people that grant the options or sell them to the option buyers. The sellers will say, the option sellers will say, well, these are the numbers that I've heard over the years. Anywhere between 65 and 80% of all options expire worthless, so why in the heck would you ever want to buy options when the odds are stacked in your favor as an option grantor? Now, on the other hand, the option purchasers say, well, when you're selling options, it's like picking up pennies in front of a steamroller that's about ready to run over you. Because sure, you might just win 60, 70, 80% of the time, but the one time that you do lose when a market has an extreme move or even a limit move against you, it can wipe out years worth of profits that you've accumulated by selling options. So both sides of the equation have merit. I just want to give you my opinion on this based on what I've done over the years. Each individual is going to have to create their very own specific trading plan that is just for them, because we all have different ideas on what risk is and how much risk tolerance we have. We also have different amounts of money to invest. We also have different time horizons for the money to, for our investments. And there's so many factors to factor in, so there's not a one-size-fits-all type of situation for everybody, but these are just ideas that might help you when deciding when to be a buyer or when to be a seller, because I think both have merit. Okay, all right. You have theoretically unlimited risk. If you were to grant a call or sell a call, there's really no end to how high the market can move against you, just like a futures contract, theoretically. I mean, no one's ever lost infinity by granting options, but there's extreme risk to the upside when you're granting calls. To the downside, of course, a market can only go to zero, so the boundary on the bottom end is finite because any commodity can only be worth zero. But just keep that in mind when you're thinking about doing this. Now, in my opinion, like I've said, there are times when selling options make a heck of a lot of sense and buying options makes very little sense, because there's times when the odds are really stacked against you. And again, in my opinion, if it's a high vega, your vega is your implied volatility. So an option, if it's extremely volatile, the person on the other side of it, the option grantor or seller or writer, whatever you want to call them, will expand the option premium because they're taking on more risk because that market's moving more and more. So those options become more expensive. Now, in a low volatility situation, the volatility premium in that option will shrink. So the option becomes more fairly valued during low volatility times. So I believe there's times when you should be selling options and there's times when you should be buying options. And if you have extremely high implied volatility or high vega, in my opinion, that's when you should sell options. If there's an extremely low volatility in the market, well, I think that the option buyer has the advantage in that case, because the option sellers have to sell closer to the money to collect any sort of premium at all. So that's my opinion. That's when I think you should buy or sell options. Low volatility, you buy them. High volatility, you sell them. Depends on you, though, obviously. Here's my rules. I have a question mark for them. These are suggestions. In my opinion, you shouldn't ever be granting options within 25% of the money. So if you're selling options, I think you ought to be at least 25% out of the money, at least. Sometimes, you might only want to grant options if they're 50 or 100% out of the money. Again, it's up to you. Whatever your tastes are, whatever you're comfortable with, you're going to create your own trading plan. That's what I'm trying to give you an idea on how to do. How much margin do you want to risk? Well, again, this is another idea. If it's an option granting portfolio, well, you probably wouldn't want to use more than 50% of your available margin, just in case something bad happens to you, just in case the market goes against you, just in case your options just explode and you got to buy them back. You want to be careful. Just like a futures portfolio, you want to leave a lot of available equity on the sidelines. Non-correlated markets. Yeah, if you're in there granting options, you don't want to grant crude oil and heating oil and unleaded gas and think that they're different trades. They're just not. They're so highly correlated to each other that chances are, if one's going against you, they're all going against you. One's going for you, they're all going for you. So you wouldn't want to do that. You want to be in non-correlated markets. Same with something like, say, soybeans and corn. They're grown in the same areas predominantly, so they're exposed to the same weather events. They're feed substitutes for each other. So very similar. So whereas soybeans and wheat, they can trade differently quite often, soybeans and corn are very highly correlated to each other. So you want to take all of these things into consideration before deciding to be an option grantor or a buyer. You wouldn't want to buy corn and soybeans typically too, or buy crude oil and unleaded gas, because they're probably going to be going the same way. They're not separate trades. In other words, you kind of think of them as one trade because they're so correlated to each other. If you are going to be an option grantor, you're going to make your own rules, but that's one that I think makes a lot of sense. Is if your premium doubles, get rid of it. If you sold it for $500, now it's worth $1,000. Cut your losses. Get out. If your premium doubles, just another rule you might want to add to your trading plan. I mean, there's tons of them. How much? This is where you question marks. Create your own trading plan. How much do you want to allocate towards any trade? Is 5% a good idea for you? Is 10% a good idea in each individual idea that you have? You really got to figure these things out before you get into these trades. Other things you want to take in consideration is, what is your exit point going to be? What's your entry point? You're figuring out when to cut losses. Are you going to buy back options that you granted if they're 90% worthless, or do you want to hold on for that last 10% and let them expire? You really have a lot of different factors that you have to take into account, and it's going to be up to you because you're the actual person that's taking the risk with real money. So if you're going to be an option grantor, there's a lot of risk there. So you really, well, there's a lot of risk if you're buying options too, but there's margin call potential when you're granting options. And that's why I'm really covering the risk a lot more. You have a lot of different rules that you're going to have that makes you decide whether or not to buy or sell an option. I think I covered mostly everything I wanted to. Yeah, okay. Well, the website is tkfutures.com. If you have any questions about selling options or buying options or anything like that, you can give me a call there. You're probably watching this video on that website right now, so you can just look for the contact information. I also wrote a book all about options. It's called The No Nonsense Guide to Buying and Selling Options. It's available on Amazon.com. I actually cover all this. I cover buying and selling options, my opinion on what I think is a better time to buy versus sell. That's all included in there. That might help you before you risk any real money. Also, we have practice accounts. So you can get into a practice account. It's a demo account. It gives you 2 weeks. It usually gives you, it's $50,000. in virtual equity. So you can get in there and practice buying and selling options with a real platform, with all the real bells and whistles. Everything's real except for the money. The money's fake. So, you know, if you lose 50 grand, it's just play. It was monopoly money anyways. But I would suggest using a practice account before you put any real money towards futures or options trading. But that's it for today. So I hope you learned something. I hope you enjoyed it. Have a great day. All right. Bye-bye.